You can easily lose $200,000 when you make this one mistake. In fact, this is the #1 wealth killer that almost no one is talking about. And it impacts people who are just starting to invest all the way to people who are analytical engineers and investing millions of dollars. So in this episode of the Property Academy podcast, you're going to learn what that #1 wealth killer is, how to avoid it, so that ultimately you don't end up burning a $200,000 opportunity. The mistake that I see investors make is often they get a little bit nervous and they start thinking with their heart more than their head. And I think you really see this within the numbers, because there was a very surprising stat that I saw the other day.
Yeah, so let's say you invest in a fund and that fund is expected to get, or it does get, an 8% return a year. Morningstar actually did a report which showed that a lot of people actually perform worse than what their fund performs.
Now, this is a bit weird though, but how do you be in a fund that generates 8% per year, but you don't get an 8% return?
You get less than that. Well, the way that ends up happening is people end up getting a bit spooked, right? So for example, if you're in an aggressive fund and you're getting this really good return and then the market drops and you think, oh, God, I've lost money. So then people switch funds and go to a more conservative fund, lock in their losses, right? And then when the market starts to go up again, they think, oh God, I missed out on that money. I'll switch back to the aggressive fund. And because they flip-flop from one to the other, they end up underperforming what the fund would have done if they just stayed the course.
And my understanding is it's about 1.1%, right?
Yeah, 1.1% is quite a big chunk of that return, right?
So if the fund was making 8% a year, some investors are making 6.9% a year because they're panic switching funds.
Yeah, which I like. We will have seen a lot of that in COVID times. Like I remember some investors I know taking all of their money out of different funds and then again piling back in when the markets went up. I mean, in their case, they probably did okay with the timing, but for a lot of people, they will have ended up losing money as the market goes down and then crystallizing those losses and then piling back in when the market's going good again. And so they don't get that benefit of just staying the course and getting that 8% return. And actually, look, I think it's an urban legend. Like we've spoken about this on the show before, but I actually heard this recently in a Diary of a CEO podcast. Who's the girl, like Chloe Sanchez or something like that? Do you know that girl?
Yeah.
So don't give me that face.
Of course
Edwards.
I do.
All right. Well, I just wondered.
I don't think her name's Chloe though.
No,
her name's not
Chelsea or something.
No, it's not.
Anyway, she told the story like I tell the story, as if it's complete facts. But we haven't been able to fact check this.
No. We know that it doesn't exist. There's no evidence that this exists.
She and I both are of the opinion that it exists. So Fidelity, who are a major investment firm in the United States, they did a study on the people.
Cody Sanchez. I knew it wasn't Chloe Sanchez.
All right, well, you didn't know what it was, though. And they did a study where they looked at who in their funds had performed best. And the people, the group of people that had performed the best were all had one thing in common. They're all dead. And so as a result, they weren't flip-flopping their fund.
Yeah, either dead people or people who had forgotten about it are typically the people who make the best returns. And the issue is that if you're in a growth fund, you might switch to a conservative fund, then you see the market heating up and it's increased in value, then you switch back to growth. But the issue primarily comes down to if the market has dropped, well, it's already dropped. Switching funds doesn't reverse that drop. Now, of course, the reason people do that is they want to stem the losses. But the issue then as well is if you then switch back into a growth fund when asset prices are rising, well, that growth has already happened. So you're trying to get on the bandwagon of something after it's already happened, or get off the bandwagon after something's already happened. And, I read this really interesting study, came out of the University of Berkeley, and it's a little bit old, but what it showed is that if you look at individual investors, right? Individual investors who are out there, and let's say they're trading between funds, they're trading stocks like really a lot. Well, over the period they looked at, the annual return that those people got, and it was a high return, but just stick with me on this, it was about 11.4% over the period they looked at. This was, like I said, it was old, it's before 2000. Then they looked at what the market return was, and the market return was 17.9%. So the cost was about 6% per year of trading frequently. And then they looked at the people who traded infrequently. Well, in this particular study, they made 18.5%. And so there is a big benefit to staying put rather than trying to tell ourselves that we're making intelligent financial decisions and switching constantly. And so this has got me thinking, well, how much does panic switching, and this can happen both in funds and Kiwi savers, but also with property, where people buy and sell really, really quickly all the time, how much could that cost you? So I came up with a scenario and I looked at, I think it was Milford's funds, so the big fund manager in New Zealand, and they've got growth funds, they've got balance funds. And I looked back over the last 20 years and I said, what if you started with 50 grand and you're putting $500 a month into the fund? And let's go back and look at how much growth funds went up and how much conservative funds went up. And if the growth fund drops by like 5% in a month, we need to switch. We need to switch. It's down 5%. We're moving it to conservative. And then once you see the growth fund going up by 3%, you think, share prices are going up. I need to switch back into that.
So did you model this out?
So I modeled it all out.
Such a nerd.
And of course you could change the factors to create your scenario. If you're sitting in the YouTube comments saying, I don't like what he did, that's all right. Come up with your own scenario. It will show similar things. And what I found is at the start, the people who stayed in growth no matter what and didn't switch their fund actually made slightly less money in the first, we'll call it 5 to 7 years. So panic switching in the early days, just in this one scenario, did end up saving this person a bit of money.
Is that because there's less money in there and it has less of an effect because of the length of time?
Well, the reason would have been that you see here that the growth fund went down in value by quite a lot. So when you initially panic switched, you did stem the losses temporarily and end up with a bit more money. But over 20 years, we see that the growth fund massively outperformed. You would have made about $450,000 if you're just stuck in the growth fund compared to about $250,000
so it's almost
if
double.
you panic switch. So that's why I said at the start, you make an extra $200,000 in this scenario if you just stuck with growth as opposed to panic switching. When you hear that, what's your takeaway from all of this?
I think the key thing is that switching costs you. And I completely understand the emotional decision to want to stem those losses, right? People worry about how bad it's going to get. And one of our independent board advisors, when we were away with him, must have been our last board meeting or the board meeting before, and there was some major turmoil in some of his investments. I remember him being like, oh God, but he's a very seasoned investor that was going to stay the course. But you think about someone who maybe didn't have that kind of level of sophistication, you could absolutely think, I can't be in all this tech stuff. It was around those Nvidia, it was around the Nvidia share drop.
Correct. And one of the things that's interesting is, as we've seen in that scenario, is switching can actually stem those losses sometimes. So even in the scenario we gave you before, for the first 7 years, that strategy worked out. I bet you made far less in the long run in this scenario, in this way of running the numbers. But it can make sense. And that's the difficulty of it. Because it can make sense, you can reason to yourself that, maybe if I switch, it will stem the losses. But actually, it can also lock them in. And over the long term, you will end up with less money, or it's highly likely that you'd end up with less money. And it's quite funny because, as some of you know, that my wife is a financial advisor. And so our pillow talk is just quite fascinating when we talk about different scenarios that we've run into. And she would say to me, you wouldn't read about it, but there are so many engineers who get very spooked when markets go down. And so even though they are highly analytical people who could read all of the research reports that we're talking about here today and say, that makes a lot of sense. But when they see the market going down, they switch. And then when they see the market going up, they sometimes switch back. Now, of course, that's not every engineer, but she's saying it's an interesting trend that she has noticed. And even though these people are highly intelligent, what they almost don't realize, or maybe they do realize it, but they do it anyway, is that over the long term, they are likely to end up with substantially less money. This is the number one wealth killer that a lot of people don't talk about. And I actually think that this applies to property too.
I'll give you an example of actually something I'm seeing quite a lot of at the moment. So I still think that Christchurch has got some serious legs in terms of being an investment opportunity. But is it my number one place that I'd recommend for people? No, not at the moment. I think like from an affordability standpoint, absolutely. From a growth perspective, it'll get steady growth over the next wee while, but it's coming close to kind of where we'd expect it to be based on our overvalued, undervalued model. However, because it's had some growth, I'm seeing a lot of investors who have got Auckland properties going, Auckland's underperforming, it's not working for me. I want to sell it and buy a couple of properties in Christchurch. Now, that is not what I would advise someone to do, but that's the mentality. And interestingly enough, I've seen a few developers and property investment companies going online talking about how great the Christchurch growth has been and how we're only like a fraction of a percent under the peak of the market. Now's the time to invest. No, that's completely the opposite of what you should be doing.
Yeah, and although you can make an argument for investing there, that big opportunity that was there in 2019 is no longer there. The opportunity is somewhere else. And so this is really where that old adage of past performance doesn't guarantee future performance, that is really what that is talking about, where you see an asset or you see a property market that's had huge growth and people think, well, I want to get into that. Well, just because it's happened over the last 6 years doesn't mean it's going to continue. In fact, the opportunity might be somewhere else where the market has been flat or been absolutely hammered. It's so funny. Wellington is so depressed at the moment that I'm like, damn, there's going to be some opportunities there. I'm not sure if it's there right now, but I'm like, you keep an eye on the Wellington City property market, the Lower Hutt property market. There are going to be some opportunities there, and probably over the next 5 years. And the reason is because it got so hammered in the downturn. Everybody's like, oh, Wellington's going through a tough time. I'm like, there are going to be some big property opportunities there.
I think the other thing to remember is like say, for example, you have got a property in Auckland at the moment and you think, okay, I want to get into the Christchurch market that's been a bit stronger in terms of performance in the Auckland market. If you've got, say, 100 grand worth of equity in that property and you sell it and you have to pay an agent's fees and you pay some staging, you have a bit of vacancy, you pay your lawyer, might cost you 30, 40 grand all up, right? You erode a big chunk of your equity in that property in that single transaction, then to reallocate that money to Christchurch, and then again, you might not get the same growth out of Christchurch as what you will out of Auckland. That really hasn't performed over the last 10 years.
Well, the big thing, though, in property is that the transaction costs, which we always say, if you sell your property for $1 million, allocate 50 grand for transaction costs, because you're going to have to pay a lawyer and your real estate agent, and there's going to be some real estate marketing. And of course, the real estate agent's fee is 3%, but it's 3% plus GST. So it's always a little bit higher than what you think it is. So allocate that money. Now, you might sell that property for $1 million, but you probably had a mortgage on that. So if you had an $800,000 mortgage on that and you allocate 50 grand for your transaction costs, you've eroded 25% of your equity in that example just by selling the property. And so I ran some numbers, and what I wanted to look at was, well, what would have happened if you started investing 20 years ago, and I haven't thought about panic switching here, but every 5 years you take the gains of that property, you sell it, and you go in and you invest in something else. And by my numbers, if you'd done that, you bought a property and then every couple of years you sold it and you repurchased somewhere else, so you would have ended up with about $500,000 worth of equity by buying and selling and buying and selling. Whereas if you just bought a property and held onto it and didn't incur those transaction costs, you'd be about $75,000 better off, because every time you decide that you're going to sell a property and buy something else, it's going to cost you about $25,000, and that comes off your actual equity.
Yeah, and that's like, when you think about it, you're like, oh, 75,000, is that a huge sum of money? Well, it is when you're talking about kind of $500,000 versus 75.
Hell yes, 75 grand's a lot of money. It's an enormous amount of money.
Only because we're talking millions of dollars sometimes with property. Sometimes people can think that it's a small number, but you think about that in relation to the percentage, it's quite large. Now, before I get a bunch of emails about this or heated phone calls from my team saying, you said Christchurch was a bad place to invest. No, that's not what I was saying. What I was saying is Christchurch has had some really good growth. What I'm trying to think about as an investor is, where hasn't had the growth, and why is that? Is there an opportunity there?
Well, similarly, if you look at a place like Mackenzie District, like where Twizel is in New Zealand, that has had just astronomical property price growth. And so if I was in Wellington City at the moment, I wouldn't be selling my Wellington City property to go invest in Twizel because Wellington City has been absolutely hammered. I'd expect that you'd have much better property price appreciation there than in Twizel over the next 5, 10, maybe even 15 years. What you want to ask yourself is, are you panic switching? Are you moving from an underpriced asset to a more overpriced asset? Because that is the danger if you constantly panic switch. And as we saw in the shares example and the property example, this could kill your wealth by $75,000 or reduce your wealth by up to $200,000 in the example we gave with the shares. And so it really is the number one wealth killer to think about. And that's one of the reasons why people who use financial advisors generally end up with more money over the long term. And we've done some podcasts on that previously as well. And the main reason is that if you use a financial advisor, yes, you're probably more likely to actually invest and make more investments than you otherwise would, but you're also much, much, much less likely to panic switch. And that's the main thing you've got to think about. But even if you have the best investment plan in the world, the government can still silently eat away at those returns through taxes. And if you don't know and follow all of the rules, you might end up tipping the tax man and paying way more than you actually need to. So make sure you watch this video to learn the 4 tax hacks that every investor needs to know. Go watch that now.